Welcome everyone. Good morning, good afternoon. Today we're going to talk about how to manage your cash flow. It's one of the most important things in a business. All business people work very hard to set up a business, then to generate revenue, and then have all kinds of expenses and manage the net income and plan on growth and use the money for growth purposes. And oftentimes the business is doing well, but at the end of the day, there is not a whole bunch of cash flow or surplus cash left. And sometimes managing the cash flow is just as important as managing the business. And today we will talk about how to effectively manage your cash flow. So I have three wonderful panelists that are joining me today. Neha from Los Angeles, Pooja from Santa Clara, and Judith also from Los Angeles. So I'll request my panelists that when I ask them their question, they will introduce themselves. And let's start with the first question, why cash flow matters. To discuss that, I'll ask Neha to please answer these two questions.
Sure, Mr. Chugh. I'll pass this on to Pooja and she will take care of this.
Okay.
Yeah.
Pooja, are you on mute?
Can you hear me now, everyone? So thank you, Mr. Chugh, and thank you, Neha. I hope everyone can hear me. Today, I fondly recollect the memories of our first piggy bank given by our parents. The value of money and thrifting are concepts that remain deep-rooted even after a couple of decades. This is Pooja.Srivastava. I'm based out of the Chugh firm in San Francisco Bay Area. I take pride in helping my clients in the field of taxation for the past 5 years. I'm going to be talking about cash and happy to cover the topic for today, effectively managing your cash flow. As our topic suggests, cash is king. We are amidst a global pandemic that the world is experiencing, unlike anything we've seen in our lifetimes. Job loss, shutting down of economies, climate change, you name it, we're seeing it all. Yet some companies are moving as smooth as silk. Microsoft is sitting at 136 billion, Alphabet is sitting at 193 billion, and this is their data as of July 2020. In a contrast, the bankruptcy of Hertz, AMC, J. Crew, Aldo, I mean, the list goes on. 16,000 restaurants have closed down permanently. Economists and experts are still evaluating the future of the financial world. No matter how fast this world has progressed, some of the old school concepts remain solid as rock. There is no replacement for good old cash. And truth be told, in the times of financial crisis, if you're sitting on a pile of cash, you're not approaching a problem with a sense of nervousness, but a great thirst for the potential of the opportunity that it gives you. So what is cash flow and why is it so important? Cash flow is basically the movement of funds in and out of your business. Positive cash flow is the amount of cash that's entering your business. It may be through sales, your accounts receivable, and it's more than the current expenses that you have, as Mr. Chugh said. Negative cash flow, as the name suggests, is the outflow, which is higher than the incoming business. So there's no secret to this. Cash flow problems can be one of the major leading causes of the failure for a business. Another point to drive home today is profit is not the same as positive cash flow. Cash flow is the fuel for your company. Without cash flow, profits are they're meaningless. Profits that does not equal your cash flow, although they're often misunderstood as one and the same thing. Profits are defined by the rules of accounting as revenue minus expenses. All right, let's break this further down. So you're invoicing a client for the product and services you sold to them. This creates revenue. Collecting that money on that invoice creates cash. So I hope that I've been able to help you with the true understanding of cash. My colleagues will take this discussion further. Mr. Chugh, I put this back to you. Thank you so much.
Thank you, Pooja. That was great. Now that we understand the importance of cash flow, Neha, can you please tell us a bit more about how business owners, along with their consultants and CPAs and lawyers, should evaluate their cash flow?
Absolutely. Thank you, Mr. Chugh. Thank you everyone for joining Chugh webinar today. I'm Neha.Karnwal and I'm a senior tax accountant with Chugh CPAs LLP. Well, since my colleague Pooja has just explained why cash flow matters, I would now like to discuss the importance of evaluating your cash flows. Of late, especially during these unprecedented times, we hear a lot from our clients. Why, despite decent sized sales, I'm always out of cash? Where is my cash going? Well, the simple answer is approach your consultants to evaluate this as soon as possible. Approach before it becomes a problem. Be proactive. This is what will distinguish you from the rest. You may think where the cash is going, but the truth could be that all your sales not necessarily translates into cash immediately, right? You may have more credit sales and overaged account receivables. Then while you wait to get paid, you may still be incurring a lot of expenditure for day-to-day businesses. Or your debt payments are huge enough to take away a good chunk of your cash income, and so on and so forth. Well, so how would accountant help? Your accountant will provide you with the specific reason for the gap between profit and cash. They can provide you an analysis of your cash inflows and outflows in the form of statement of cash flows, along with cash projections, which could be short-term, medium-term, long-term. Such information, if provided timely and periodically, can help you control the inflow and outflow of cash more effectively. Currently, cash flow management should be a part of your day-to-day reviews. So, what is a statement of cash flow? A cash flow statement is an informative financial statement that offers quite a bit of insight into company's financial health. Good thing is that your accountant can provide you this statement not just once in a year, instead periodically throughout the year. It could be monthly or quarterly or even daily if required. This would mean you can get a lot of time to evaluate and correct what is required so that you can maintain sufficient liquidity in your business. Not only this, your accountant could give you interesting business insights, based on review of your cash flow statement. For example, what's your company's financial flexibility? Which means how much free cash flow does your business has at any given point in time? Free cash flow means operating cash flow less the capital expenditure incurred to maintain current business operations. The higher company's free cash flow is, the more flexible that company is when investment opportunities present themselves. Another interesting fact that your accountant could address is cash flow to debt ratio. Now this tells you whether you have enough cash to service your debt payments. Further, this could cover immediate short-term debts maturing within 1 year or all debts outstanding as on a particular date. Now, based on such timely presented cash flow statements provided by your consultants, you would be able to better assess your current situation. Hence, you will be able to better monitor vendor payments, the likelihood of collection, etc., etc. So now, while you know that your consultant can help you assess the current situation by presenting a cash flow statement, what if the current does not hold good for the future? What should you do to be business ready for the future challenges and opportunities? While it is absolutely imperative to accurately assess the current situation, however, it is equally important to precisely project your future state of affairs as well. Your accountant can assist you not only in developing a precise projection, but also in laying down a step plan to bridge the gap between current and future. They can help you understand better what's behind your numbers, as numbers don't lie. They can give you weekly, monthly cash projections to have better control. They can help you compare the budget versus actual periodically. They can help you undertake periodic bank reconciliations and cash handling reviews. Not only this, they can assist you in inventory management as well. They can assess the current inventory levels and turnarounds and project for the future. They can understand and guide you on internal processes for handling inventories. Further, they can assist you in managing account receivables and accounts payable by providing a continuous update on aging receivables and monitoring payables to see if there is a scope for payment deferrals, etc. Now, assuming you approach your accountant and you got all the relevant information and insight about cash flows, will that alone guarantee success? The answer is no. It is action that guarantees success and not mere information, right? So there is a need for a change in the management culture. You, the management, have to be more disciplined than ever and work on the set criteria based on information provided by your accountant. This disciplined approach will help you effectively progress towards your future goal. Only when the management understands the value proposition in following a systematic approach, they will be able to pursue everyone to follow their footsteps. Okay, so given that now we have a committed management to work on a specific plan to sail through these tough times, what would management like to see in the future cash projections? Amongst other things, future cash projections should certainly provide management a bird's eye view of the business cash flow. And so it should be broken down in various expenditure categories and revenue streams. While on the expenditure side, it could segregate the outflow for fixed monthly payments such as rent, property taxes, loan payments, etc. On the variable side, it could segregate payments into credit card payments, accounts payable, government tax remittances. Also, for capital expenditure, it could cover clear differentiation between immediate capex needed for running the business operations effectively and capex that could be deferred without disrupting usual business operation. For revenue projections, management could have weekly and monthly revenue projections for different revenue streams as applicable. This will be based on analysis of businesses' historical volume on existing contracts after accounting for changes due to COVID-19, of course. Also, revenue projections would take into account timing of collection of account receivables, etc., right? Now, cash projections can help the business to plan for extra expense. You can change the dates of variable expense where possible. You can understand how much cash on hand you will need at any given point in time. The good thing about this is that your accountants can help you to simulate and run various scenarios. Imagine you can just say that what will happen to my cash projections if I were to change outflow by 10%? Or if I am able to defer these payments, what will happen? Or if I can get more lending, does it get me through the next 2 months? And so on and so forth. Now, since we are talking about cash flow projections and cash flow statements for management to review and work upon it, so there are two critical aspects that we need to cover here. One is we need to understand what is cash conversion cycle, and the second is what is working capital. Now, what is cash conversion cycle? In simple terms, it is the number of days that it takes to essentially convert inventory into sales and then sales into cash. And similarly, working capital is the money that you need to continue with day-to-day business operations. While a business waits to get paid, it must pay for certain needed expense, such as for material, for salary, and so on. So the total money it spends while waiting is your working capital need. Now let me just elaborate a little on the interplay between the two concepts. If your business has a really short cash conversion cycle, then you certainly need less working capital. Reason being that your company generates sufficient cash to timely cover your day-to-day expense for running the business. Vis-a-vis, if your business has long conversion cycles, then you will spend more out of pocket, right? Because you are waiting longer to get paid. On top of this, your need for working capital will increase as your business activity increases. And because you have to meet growth, you will therefore spend more money. If you have deep pockets, you can aggressively grow, but if you do not, you will hit a brick wall because you'll run out of money before your customer can pay you. Now, alternatively, you can secure enough working capital financing to support your growth, but be mindful that financing comes with a cost as well. Hence, it will be efficient if you first look at improving the efficiencies of your operation and finance processes. Now, since I have discussed about cash flow statement, let us look at one sample cash flow of the biggest brand in the world, Apple Inc. I'm sorry, I think this might not be legible, but let me try to broadly explain it. So if you could see on this slide, while Apple Inc. has a net profit of $45 billion in 2016, however, the net cash available at the year end is less than half of the profit, that is $20 billion approx. And that trends continue from the past years. So certainly this shows that net profit does not exactly translate into cash. Similarly, you would see that in the first adjustment section as to how non-cash items have been eliminated to arrive at cash outflow and inflow. Items such as depreciation, deferred income tax, etc., which really does not impact your cash flow. Not only this statement also helps you understand how cash is generated from current assets, such as account receivables, inventories turnaround. And it tells you how cash is used in paying off your liabilities, such as accounts payable. On top of that, it covers cash inflow and outflow from various investment and financing activities, like equity infusion, lending, investment in various securities, etc. Imagine if you get this detailed level of statement not only once in a year, but multiple times, maybe monthly or quarterly or even daily. And if this accompanies correct, right cash projections, this will turn out to be a very effective tool to provide management with the desired control over the cash flows. Before I conclude, I would like to say that unless you understand the root cause of your problem and approach an expert for a solution, you may only get a temporary relief, which is not good for health. With this, thank you everyone. I will hand it back to Mr. Chugh. Mr. Chugh, I guess you are on mute. Mr. Chugh, I guess you're on mute. We cannot hear you still. Yeah.
Okay, sorry. So after we get a better handle on cash flow, the next question is, what can businesses do to improve their cash flow? Judith, can you guide us on how we can improve our cash flow?
Of course, Mr. Chugh, thank you. Hi, everyone. I'm Judith.Terre. I'm a CPA based out of the LA office. I've been with the firm for 9 years. Please let me know and want to apologize in advance if my audio doesn't sound clear as I'm sharing bandwidth with 3 more people in the house. Okay. Well, Pooja discussed how important the cash flow is and can't stress it enough because no matter what size of your company is, what type of company you're running, cash flows is extremely important. After all, it's cash is the lifeblood of a company. And in these uncertain times, managing your cash is a critical priority and a necessary part of any survival plan. So besides just increasing revenue and minimizing expenses, which are the obvious ways to improve cash flows, there are some strategies and business practices which I will talk about. First off, as much as you can, maintain liquid assets and a cash reserve. Why is this important? First, you have something to use when unexpected expenses come up. This is basically your dry powder. Like Neha mentioned earlier, you have the potential to grow your business. You can strategically position yourself when opportunities are available, or you just want to avoid taking additional debt if there are significant adverse changes in your revenue streams. And your accountant or CPA can help you determine how much reserves to have on hand. Another strategy is to stay on top of your receivables. To do that, you need to examine how your business handles the collection process. Get the basics right, such as timely and accurate invoicing. As we all know, any errors in your billing process can lead to costly delays in receiving payment. Have your team review overdue accounts each week and follow up regularly with customers. You may also want to focus on customer-specific payment performance. Identify customers that may be changing their payment practices and create a plan accordingly. So the idea is to speed up the accounts receivable and collection process. Other ways you can do that is using the lockbox services hosted by post offices or serviced by banks for faster processing. How about set up direct deposits or entice your customers with discounts for faster payments, or maybe switch to cash sales? And during unprecedented times like this, it's not uncommon that some of your customers are having liquidity problems and maybe delay in paying or not able to pay you. So again, the option is create a plan, maybe an installment plan, depending on your relative strength. Understand the impact on your business and the cash flow implication if this customer would pay or delay in paying you. So take a look first, what's your risk exposure if this customer would pay you? But you need not to alienate your customers, because in situation like this, the key is to bend and not break. Just make sure your invoice is top of their list. So keep in contact with your customers, communicate, maintain, and build that relationship. I mentioned earlier the discount for early payment. On the flip side, for late payers, you collect interest or penalty. By doing this, you emphasize the importance of on-time payments to your customer. Tightening credit requirements is another way, and actually a great way to make sure, or at the start, you already have high probability that you'll collect, or maybe renegotiate terms if you can. Just because you've been doing one thing in a certain way doesn't mean you cannot change it. So it goes back to, I mentioned earlier, reassess your customers and their payment performance. But if you're really in a tight situation, you can explore options to create liquidity through invoice discounting or factoring your receivables. Invoice discounting enables you to borrow funds using invoices as security, while factoring, you sell your invoice or receivables to a third party at a discount. If you resort to this, assess which one gives your company the optimal approach in terms of both cash flows and operational perspective. During COVID-19, you need to reassess your customer base. How is COVID-19 disrupting customer purchasing behavior? How are your sales and delivery capabilities being disrupted by COVID? Based on your assessment, segment your customer base and create what strategies to use. Now, moving to payables. Talk to your suppliers, be honest. Ask if you could come up with an agreement that allows you to take longer to pay or give you the most favorable credit terms, or maybe negotiate early payment for discounts. I believe under the current situation, suppliers are more likely to be receptive in terms of extending credit terms. With respect to inventory, managing your inventory effectively plays a big role to your cash flows. Like you need to update inventory safety stock to reflect the increased demand and supply volatility. Like maybe you'll be thinking about securing additional inventory or strategic stock as a buffer against potential impact of a prolonged supply chain disruption. And for these, you may inquire about volume discounts and rebates, or reduce your inventories, especially in perishable products or slow-moving products. And anyway, there's no point in keeping a surplus of inventories around that sells sporadically. And managing your supply chain risk definitely drives your cash flow as well. One way to mitigate this risk is, for example, if you manufacture a product and want to sell it to someone outside your borders, you can typically require a letter of credit from a bank that proves the buyer can pay. This letter of credit not only provides a source of ultimate payment, it can also be used to secure inventory financing while the goods are in transit. So it's important to make sure these letters of credit are still reliable. Again, it's equally important to build a relationship with your suppliers. Ensure you understand the financial risks of not just your customers, but also your suppliers, which is a critical consideration in this time like this. I want to turn it over back to you, Mr. Chugh.
Thank you, Judith. Thank you very much. So Judith, in terms of budget, what steps can business owners take to increase the cash that they have coming in?
Sure, Mr. Chugh. Okay. There are other ways to increase the cash coming in. One way would be really focused, targeted revenue growth. Increasing and diversifying sales is another way. Or you sell more to your existing customers. Or if your company is selling only to international, you can pivot to domestic markets. You could also consider online virtual shopping and service models, and maybe offering value to different customer groups, such as by launching a product that is in greater demand right now, or affiliate with other brands that sell complementary products or services. Or if you just want to maintain currently what you have, identify what products with most profitability and focus on that, and discontinue the least profitable products or services you have. So it's a good idea to identify your core business and key competencies. You may also want to reassess your pricing. Make sure you've updated or pricing your products or services correctly. Find out how to get a premium price for your products and services, or how to get consistent margins. Another way how to improve your cash flow is also through financing. The benefits of debt financing are that it's cheaper, interest is tax deductible, and personal risk is mitigated. While equity financing could cost more and could dilute your ownership, but I guess in times like these, it could be no value. So evaluate whether your current financing is sufficient to carry you through recovery, and will your lender consider perhaps modifying your current operating facilities? There are also government loans or government funding options out there. For example, you may be qualified for loans like EIDL or SBA loans or Main Street Lending Program. And another cash flow inflow is also through investors, or like I said, your equity financing. If you're willing to give up a portion of your ownership or even control, then you can do this route. There are still investors who are looking for new business opportunities despite the economic circumstances. Strategically consider when to ask for another round of funding, because your business valuation may have dropped. But be prepared also, because investors will scrutinize your business and market potential even more closely than they may have before. Your accountant or CPA can help you create the investment plans and investment pitches. After you've identified what are the cash ins and outs for your business, make sure to see the complete picture, the holistic view, particularly during uncertain times like these. assess your business needs within the context of immediate term, and forecast your cash flows for a rolling period of 13 weeks, making adjustment on a weekly basis to monthly. Depending on the variables and assumptions that change each week, and tie back into your balance sheets and profit and loss to see if everything is according to your business plan. That 13 weeks would give you the most accurate period because it provides more visibility because of the short-term horizon. And then when everything will stabilize, then forecast your cash flows over the longer term. Run few scenarios like Neha mentioned, including a worst case pessimistic view for you to see how worse it's gonna get so you can plan accordingly. Again, for all of this to work, you need to assess your business. That's your business acumen come into play. Create a plan, model it out, adjust your cash flows when necessary, and implement those plans to work effectively. In the current situation, you need to be both adaptive and resilient to survive. And let's not forget to be empathetic too. That's the end of my presentation, but Pooja will discuss more of other ways to improve cash flows. Thank you, and now we'll turn it over to you, Pooja.
Thanks, Judith. So much learning about, unlearning what you've done in the past, and so much that you've done before. Businesses need to kind of evaluate that. So thank you, Judith, for that. So now a few of the other techniques that most people know, but we're just going to drive down that point and tell you: reduce your variable costs. Your business is going down, revenues are off and on, coming in and going out. So a lot of people have started hiring freezes, which is one of the first things that people have done. Reduce your contract labor, distribute it to permanent workers that you have. Encourage paid leave. You don't want a huge PTO sitting at the end of the year because of the volatility of cash that's coming into your company. Also have performance-based compensation for employees. That's one of the nicer ways to go about it when you're, kind of managing things based on and waiting for revenue to come in. Review your credit cards. This is not only just important for smaller companies, bigger companies. This is for everyone, individuals, right? You have a shop, you have a mom and pop. Everyone, please review your credit cards to see what's going in and coming out. That's exactly cash sitting right there. Discretion on entertainment and training, non-essential travel. It goes without saying that if it's not required, let's not do it. The second point is convert fixed costs to variable costs. Let's say a huge part of your business is having those salaried employees and also paying some amount of money on the building that you own. You had 100 to 200 employees in the beginning of January 2020, and now you're sitting at 20 employees that come in and go out. Of course, it's sitting in your face. Do I need such a big building? Should I lease that out? Do I need to own this building? What are the other consequences as we go forward? And this goes well for any kind of fixed asset that you have. I don't know of any company that has not, had a kind of a cut on printing costs, on supplies, on cafeteria expenses, on electricity, admin, advertising. And I think if you have not figured out this by now, please go back to your books and see that if your revenue has gone down substantially and these costs are continuing to stay stable, you're going to cut down these fixed costs. They are of no consequence to you. And the third most important thing, outsourcing. I think we've all tasted blood. This is a new kind of working, online working, and nobody ever thought that the world could continue to function the way it does because things can be done online. Contract labor, sales representations, admin work, PR, hiring, marketing, name it, and even webinars like this. Everything can happen online. You can connect with people and you can get your work done. So it doesn't really matter where the employee is sitting in the world, as long as he can get the job done. For any normal person to correlate with what I'm saying, Your next appointment with your doctor, which is your yearly appointment with your doctor, is also online now. So this is where we've gotten from January to October. I don't know how things will be, down another year. There's just more and more opportunities, more and more things. Keeping the cash that's coming in your mind, plan for future, and get an accountant or lawyer on board to help you with this. The other thing that we talk about is, and Judith has gone in detail, I'm just going to kind of brush it up a little, is use your customers and vendors as creditors. Initiate some kind of discounting, have them pay earlier. I don't think there's rocket science, and you've already given them the service, the product that you have. Make it more lucrative for them to pay faster. Build up relationships with your vendors and banks and accountants, lawyers. Yes, we have gone online and it's much easier, but there's a little bit of caveat. We need to communicate a lot more than we needed to, because if you were in front of me, I understand, the whole 360-degree picture of what you're going through. Now it's more important to have proper agreements, terms and conditions, email chains and documentations. This only makes your vendor relationships, your client relationships much more smoother. I hope we've been able to gather and collect enough information for today. This completes our topic. Mr. Chugh, I give it back to you. Thank you all for listening. I think, Mr. Chugh, you're on mute,
Okay.
maybe?
Sorry.
Yeah.
Thank you, Pooja. And thank you, Neha. And thank you, Judith. Also want to thank Sasha and Francesca and Deepa for helping us put this webinar together. At this point, we'd love to take any questions if we have from anyone on this topic or any other. Okay, so we have some questions. Go ahead, Sasha.
Sure. So the first question that we received from our clients is for Judith. Judith, what would you do if a customer just deliberately doesn't want to pay?
Thank you, Sasha. That's an interesting question. Well, in a normal situation, or if a customer is just deliberately not paying, you need to assess what's your fit or position in the cycle. Are you essential to your customer's business? And if so, then you can use leverage. You can stop delivery or only provide services until payment is received. Or for future delivery, you can make arrangement like COD, or maybe require bigger percentage up front. I think that's my point of view on that one. Hope that answers your question.
Thank you, Judith. Yes. Pooja, to work around cash flow, please tell us how revisiting capital investment can help.
I'm going to answer that question with a couple of questions, because this is going to depend on each client situation as we move forward, and highly recommend them to contact their trusted advisors on this. Look at your cash flow forecast. Consider what is necessary in the near term, and understand if it's really important. So when you're revisiting your investment strategy, it's very important to see what you have now and what you want in future. And this will depend on company to company, person to person. The second question, very important question for now, is can this investment be postponed until the situation improves, till you have more clarity about your business? Third thing could be, can we just reconsider this? Do we really need it? Right at the bottom, just plain and simple, do I really want this investment? And probably the fifth question, the last question, would be investment which is required. Is it required for a rebound? Does this help me get back everything into action? Am I using this for another business, another kind of business that has created its opportunity? Does this create a competitive edge for me against the other people in the market? So these are some of the questions, and of course we can help with more if we are able to see the cash flow, your profit and loss in a balance sheet, and compare what you have in the past and in the future. So I hope that answers in some way our question, Sasha. Thank you.
Yes, wonderful. Thank you, Pooja. Just a reminder for those of you in the audience, if you have any questions, please feel free to enter them into the chat box. And if we have enough time, we will pose them to our panelists here today. My next question is for Neha. Neha, can I take out 2 EIDL loans?
Hi, Sasha. Thank you for that's a very relevant question, actually, because we have been hearing from a lot of our clients that they have already taken one EIDL loan. So can they apply for another, because either they have run out of funds or they have faced another disaster because of California fires and then storms, etc. So yes, they can certainly apply for another loan if it is because of a disaster or which is different from the COVID thing. Then yes, they can apply for an SBA disaster loan. Otherwise, if they believe that they are not in a disaster zone, but they still need more funds because EIDL has they've run out of money and EIDL wasn't sufficient, then they can apply for additional funding on the EIDL. Those options are available.
Thank you, Neha. So Judith, one client asked, my business is significantly impacted by COVID-19 and it's on the verge of closing down. Is it a good idea to put more money into my business from my own personal funds?
Thank you for the question, Sasha. If your business is significantly impacted, or you close down your business, or just on the verge of closing down, definitely assume less to no income or cash coming in. Just because you close down your business doesn't mean expenses stop there. You may have your rent, your fixed expenses, or contracts to pay your suppliers or service provider, but you cannot just drop everything, or you may be in violation of your contract. There's still a runway for your company, most likely reduced, but you still need cash to take care of those. That's why cash flow or forecasting cash flows is important. And to answer your question, to infuse more capital from your personal is really helpful. That's your dry powder right there. Be cognizant though, as transaction between company and personal tends to blur. Just make sure you've created a business plan to get out of that situation, because at the end of the day, the question you ask yourself is, what would be the impact to you personally? That's just my point. I hope that somehow answers the question.
Absolutely. Thank you, Judith. We have another question for Neha. So a client said, I have a small business. Will I qualify for mainstream lending?
Oh, wonderful and tricky question. So mainstream lending has come with an intent to actually help medium and small size businesses. However, the issue is that banks were initially a little resistant in taking up this loan scheme. But based on my recent study last week, I think that Federal Reserve Bank has been able to convince and have been interacting with the financial institutions just to make it more easy and make it as available as EIDLs, SBA loans, and PPP, etc. was. Yes, so we are hopeful, and for all our medium and small scale businesses to approach their financial institutions and get more detail about it so that we can help them out.
Thank you, Neha. So we have a few minutes left. If anyone has any questions, please submit them into the chat box. We will stick around for a minute or two more. And if you aren't able to think of your questions at this time, feel free to please note down the email addresses that we have on the screen for each of our presenters. So we will just give this 1 to 2 minutes. Please enter your questions into the chat box. Thank you.
So with that, we look forward to your questions by email. and happy to assist you with your business issues, cash flow, and any others. As you know, we are a full service legal and financial tax firm. We do corporate work and tax and litigation and immigration and employment and M&A, and specialize in handling people's problems. And we've been in business for 35 years, so any problem you come across, we've had an opportunity to handle it in the past. And we have 7 offices in the US and 7 in India. And we have affiliate organizations that we work with throughout the world. So any problem anywhere in the world, happy to assist any and all of you. We wish you all the best. This too shall pass. Yes, it's taking a bit longer than we thought, but it will pass. And stay focused on your business and take care of yourself and your families. Thank you for joining us today.